Hi, everyone, and welcome to our webinar, Addressing Carbon Accounting Challenges in Private Markets. We're so glad you joined us today. My name is Meredith Binder, and I'm the Chief Marketing Officer at Novata. For those of you we haven't met yet, Novata is a software and advisory company that works specifically in the private markets to support investors and private companies to collect, manage, benchmark, and report their sustainability data. And of course, this includes carbon data, emissions reporting, and target setting. You can learn more about us at novata.com and join our community on LinkedIn. Today, we're going to talk about carbon accounting, why now is a great time to get started, and some of the challenges and opportunities we've seen by companies who have already started to collect and set targets against this data. Our panelists today are Mark Cruz and Mark Fischel, both industry experts in this area, and I'm going to ask them to introduce themselves in just a minute. But before we get started, I wanted to remind all of you that we are interested in your thoughts and your questions, and we encourage you to enter those in the Q&A widget on your screen. I'll be monitoring that to make sure we're covering the topics that you're most interested in. And now let's get started. Mark Cruz, over to you. Tell us a bit about yourself.
Hi, everyone. I have spent the last at least 10 years of my career focused on environmental sustainability. I am a Harvard fellow in the sustainability area, and I spent the last 5 years of my career at Microsoft as the general manager of sustainability solutions. So this is a centralized organization that works across the entire company to help decarbonize the company, as well as help all of our Microsoft's customers. I retired from Microsoft in late 2023 and have been focused on advisory board work, including with Novata since then, and I'm very happy to be here.
Thank you for being here with us, Mark. We appreciate it. Mark Fischel, over to you.
Thanks, Meredith, and hi, everyone. It's great to be here. My name is Mark Fischel. I'm the head of product at Novata. I've also been working in the carbon accounting industry for several years now. Most recently, whilst at Novata, I've been leading on the build out of our in-platform carbon accounting tool called the Novata Carbon Navigator, which we launched in January of this year. And that's now being used by several hundred companies worldwide. Before joining Novata last year, I actually built my own company in the carbon accounting software space. We were helping large companies, predominantly Fortune 500 companies, track the emissions in their supply chain, so in their scope 3, giving them software tools that they could give out to their suppliers. So absolutely love working in this industry, really looking forward to this discussion. I'm sure we're going to get into some interesting topics, so great to be here.
Thanks. I can't wait to hear what you both have to say today. I know we're calling in from a variety of places around the world, but here in New York, it is full on summer. It is hot and steamy. So why is now a good time for firms to focus on their carbon accounting strategy? Mark Fischel, why don't you start?
Yeah, absolutely. I think before I dive headfirst into the why now question, just a quick whistle-stop tour for those of our attendees who aren't quite as familiar with carbon accounting. So at its very core, carbon accounting is all about bringing together on the one side all of the business activities that you undertake as an organization, and then on the other side matching that up with what are called emissions factors to work out what is the carbon emission impact of each of those different business activities. So, for example, on the one side, maybe driving a mile in a diesel van. So you have that information on the business activity, and then you need to know, okay, what are the expected carbon emissions or carbon impact or GHG emissions, because confusingly carbon is used as a byword for all GHG emissions. So once you have that, you just match it up, and then you have a carbon footprint for that activity. So although in theory it's very simple, it gets complicated when you think about all of the thousands of business activities that a business undertakes in the course of a year, and then matching it up with all the right conversion factors. And to answer your question directly then, Meredith, gone off on a little bit of a tangent there. Why is the summer the perfect time to get to grips with carbon accounting? Well, at the core of it, we found it's to do with the nature of the annual reporting cycle. So just like how financial reporting reaches a crescendo in Q1 as everyone's scrambling to get together the annual accounts and get them audited, something similar happens in the world of sustainability and ESG reporting. All of the requests seem to go out in Q1, and then companies receive those requests and then have to get all their data together and complete the reporting requirements that they have for that year. Now, that is often, as you can imagine, a bit of a mad rush. And so what we've learned firsthand from the companies that we work with at Novata is that the summer months post that reporting rush are a really great time to think a bit more strategically about all of the different data inflows that go into a carbon inventory, and think, again, strategically going forwards around what a good decarbonisation strategy looks like, how you can improve your carbon accounting year on year. And so what we've branded it, internally, we're calling it, kind of the summer of carbon. That's the best time. You have a bit more time to really get to grips with your carbon inventory. So hopefully that gives you a flavor, Meredith, of why we think summer is the perfect time for getting to grips with carbon accounting.
Thanks, Mark. That makes sense. Summer of carbon, love it. So getting ready internally to be prepared for when you do need to report it. We're also hearing a lot about regulatory pressure, and I'd love to understand how existing and emerging regulatory pressures or compliance might also be impacting both this timing and what we might need to do for carbon accounting reporting. Mark Cruz, would you like to answer that?
Sure. It's interesting to think about carbon reporting in sort of a longitudinal history, because if you think about going back to 2018, 19, early 2020s, you really saw leading companies wanting to do carbon reporting because it was the right thing to do. And let's call that like the leading edge of people. But we're now really into the, what you would maybe think of is the early majority, or even the mainstream part of it, where the world needs everybody to report. So countries that are the most progressive, and I think of Europe, and I think of the state of California in the United States, are really starting to push regulatory pressures down on companies. Notably in Europe is a new regulation called CSRD, which stands for the Corporate Sustainability Reporting Directive, directive being the operative word. And this is out of Brussels, which will require any company that does business of more than $20 million in Europe, or any company domiciled in Europe, to report on 1,144 fields of data annually. So this is not just carbon, but really across E, all environmental, S, social, and G, governance. So it is a broad, sweeping, very aggressive set of reporting requirements that will have teeth in it. So we've moved from do it because it's the right thing to do it because you have to. And CSRD starts to implement in 2025. So this is the last summer of carbon that will happen in 2024. So it's really a great time for people to do that. But I can't emphasize enough how CSRD is really going to test companies and require people to have their data hygiene in a great place, so they can actually produce these reports and hopefully glean insights from them and take action. Not just get the reports out the door, but actually improve the way their company operates. And the U.S. SEC, the Security and Exchange Commission, will follow in not too long as well. So regulation is coming, and companies need to be prepared.
Mark, you just mentioned CSRD is coming out of Europe. Does that mean if I am based in the United States, I don't have to worry about that?
No, that means that if you are a company anywhere in the world that does more than $20 million of business in Europe, which is not a very big amount, you will have to comply. So CSRD affects about 50,000 companies, a very, very large number of companies. And most of those companies will, because they need to do this reporting, they will push on their supply chain. So indirectly, CSRD will affect, millions of companies, because there will be companies that don't have to report to CSRD, but they are a supplier of a company that does. And so it will just have this ripple effect through the entire world of companies.
Sounds like a lot. Um, and if I was new to this process, I might be concerned about how to get started and get prepared as I think about my own summer of carbon. Last month, we held a climate networking event in London, and a key takeaway from that discussion was that carbon accounting really needs to be a team sport. So I'm curious, what recommendations do you have for bringing the right team together to get all this data aligned and cleaned and ready to be reported on?
Yeah, I can jump in on that, Meredith. Yeah, so I think exactly as you say, carbon accounting, just like sustainability, making sustainability progress internally requires, it's a team sport. And I think for carbon specifically, what we've seen work well is really starting with the why, bringing a broader team along with you, because they believe that it's going to be a really good thing for the business as a whole. Like, the reality is, to do this properly, you're 100% going to need to interface with the finance team at some point. To Mark Cruz's point, you're going to for sure need to work with your procurement team. You're also going to have to work with probably HR, ops, facility managers. So there's lots of different stakeholders. But I think the key thing as the person leading on this effort is to come back to the business case. Okay, do we want to do business in California or Europe? Okay, well, we're going to have to do this according to the rules of that jurisdiction. Do we want to do business with some of the largest companies in the world? Do we want to continue selling to them? Yes, of course. And so making that broader business case can really get broad stakeholder buy-in, so that it's not a chore or it's not a burden. It's actually a lever for value that those different individuals can be a part of and play a role in really driving your business forwards through the lens of carbon accounting.
Thanks. Mark Cruz, in your experience, do you have additional tips for how to bring internal or external stakeholders along on this journey?
Yeah, having been at Microsoft from the very ground floor of this idea of let's lead in environmental sustainability, there really is an important set of organizational structures and processes that go into the idea of what we would call operationalizing sustainability. Typically, most companies, even medium-sized companies, not necessarily just large ones, they have some sort of a matrix where you have centralized functions like legal and procurement and finance, and then you have business groups that do various business activities. And it's really important to figure out the right organizational construct. In most cases, that means a centralized team. And in some, whether it's reporting up through the legal organization or the policy group, that has very specialized skills and broad authority to work across all of the business groups. So you'll need to have somebody in charge that says, okay, we're going to set goals, and we're going to work collaboratively with all of the business groups to set goals on decarbonizing from sort of point A to point B. It's also important to think of a funding source. Typically, in a decarbonization journey, there are two verbs. There is reduce, so take an activity that has X emissions and reduce it to 0.5X. And then the second verb would be remove, participate in carbon removals to remove emissions that you can't abate through reduction activities. And those goals are best set centrally and then fanned out across the company. At Microsoft, I used to joke as a former Excel person that my team was a row in a world of columns, because we cut across all of the groups and we worked with all of it. But you really do need the North Star to come from a centralized organization in the company, even if you're not a very large company, but somebody has to have the single sort of pane of glass, the single point of view on how to do this. And then the last thing I would say is that don't underestimate the importance of employee engagement. Some of the best ideas can come from people that don't have sustainability in their job title and that are just rank and file employees who have an idea. And we don't have time now, but I could give a bunch of examples of how Microsoft, some of the best ideas came from employees through hackathons and other things where they said, hey, I have this idea, and it ended up being a very big idea.
That's terrific. Thank you for sharing. I don't think I'm going to forget the comment, be a row in a world of columns. I really like that. Um, we have attendees listening at various different stages in their journey. So I want us to provide some tips for those who are maybe new to the process of carbon accounting, as well as for firms who may have already started collecting this data. Maybe it's their second summer of carbon. So let's start with firms who are new to the process. Know your why, bring your organization along. After that, what is the first step they should be thinking about as they try to wrap their arms around this data collection process?
Yeah, so I think and we've worked with quite a lot of companies who are like, oh my gosh, carbon accounting, this seems like a lot. Like, where do I actually begin? So I think I'd say, first of all, you should start with the controllables. So again, going into specific domain terminology, there are these things called scopes. So scope 1, 2, and 3. Scope 1 being the fuel that your business uses, so like petrol or gasoline, etc., broadly, and then scope 2 being electricity. And those two things, for every company, they should be able to get data on that, track it, and influence it in some way. So really, and it's not actually incredible for most organizations, it's not incredibly complex to get that data and start tracking it. So I'd say, number one, start with scope 1 and 2, which is essentially looking at your physical locations. Most of all, that's really something that you can wrap your hands around and get started with straight away. So if you've never done anything before, start there. And then for the more ambitious folks who want to expand to scope 3, which is broadly, everything else that doesn't fall into those two scopes just mentioned. So that's things like your supply chain, your investments, your transport and logistics. It's huge, right? And that's where a lot of companies can get overwhelmed and scared off. So I think that the advice there is do an exercise, work out which parts of scope 3 are material for you. If you're an investor, it's going to be your investments. That's going to be the most carbon intensive part. If you're selling electronic devices, like Microsoft Xboxes, it's going to be the electricity used to power those devices. And so it's going to be the category 11 use of sold goods. So the best thing to do for scope 3 to get started is to do a bit of a high level materiality exercise. These are the 2 or 3 categories that are likely for my industry to be very high emitting. And let's just start there. Let's not try and boil the ocean and do everything. Let's start with the bits that we think are going to be really material for our specific business. So I'd say those would be my 2 big tips. Start with scopes 1 and 2, start with what you can control, and then do a materiality exercise to focus in on scope 3, where it really is going to be material for your business.
Mark Cruz, would you agree with that? Or do you have other approaches that you've seen work?
I would definitely agree with that. It is overwhelming to a lot of companies, and it's really important to sort of get your point A. Point B is the place you want to get to, but you can't define point B without first defining point A. And that is, as Mark Fischel was saying, understanding your scope 1, scope 2, and scope 3 emissions. Just to really emphasize the complexity and the importance of scope 3, for most companies, scope 3 emissions are well over 80% of all emissions. And this, at Microsoft, it's actually 96%. For example, if you're building a data center that has capital goods, a lot of things that you would purchase, and these would all fit into scope 3. And one of the ways to take this big overwhelming thing of scope 3 and make it more manageable is to look for the 80-20 rule, or the places where there is concentration of emissions. Excuse me. For example, if you're building a data center, the bulk of your emissions are going to be in concrete, chips, steel, electricity consumption, and all of these. Well, that would be scope 2, but concrete, chips, and steel. Just take those 3 things. For most companies in the data center business, that is the bulk thing. And then you have this long tail of other activities that could be in the hundreds or even thousands of activities. Really just start with the head, the main categories that are the bulk of it, and develop relationships with those suppliers so that you have the ability to share data and report. And we can talk more about a supplier code of conduct in some of the next questions. But it's really getting a handle on point A and the major activities of scope 3 as part of that.
Thanks. So scope 1 and 2, and then understanding what's material to my business to get started with scope 3. Once I have started to collect that data and calculate and measure it, how do I know if it's good? Is good a thing that I'm striving for, or is that a different strategy I should be thinking about?
Yeah, I think the first question that we always get is like from the hundreds of companies that we've worked with through the Novata Carbon Navigator. It's like, okay, I've got my emissions there, 3,500 tons. Okay, like, so what? Is this good? Is this bad? Indifferent? And so I think there's 2 parts to this answer. One part is that one really helpful thing is actually to get a quality data set that can show you how you are performing against your peers, against similar companies, in terms of size and industry. And so we've found it really productive providing benchmarks to companies at the point where they've measured their emissions for the first time, so they can see, how they stack up. But the other thing is, the other part of the answer is, this is actually a competition with yourselves. When you think about like a science-based target, it's all in relation to Mark Cruz's point A, or to your carbon baseline. So actually the big piece is to work out, not am I doing well, badly, indifferently. It's like, how do I go from the here and now, to quickly decarbonizing my business? So it's more about your own organization and how you can change that, rather than being, okay, I'm good, bad, indifferent, if you know what I mean. Although that is really helpful context to sort of put these numbers into something that has contextual relevance for companies. But I'd say, the purpose of getting to point A is really, now it's like, okay, I can work out where are the hotspots, where are the bits of emissions in my own inventory, and take action to reduce my own emissions. So it's a race with yourself more than anyone else.
Thank you. So the lens is really, you will have to collect scope 1, 2, and 3 as it relates to regulation requirements or compliance, but you should really be thinking about all of this as it's material to your business and how it will drive your business strategy going forward. Helpful. Thank you. Mark Cruz, back to you. We have heard you say in the past that we are at a state of carbon counting right now and not yet carbon accounting. And I'd love to understand what you mean by that.
Yeah, it's a great question, and it's if you think about counting dollars and you think about counting tons, the world has been counting dollars in finance groups across all companies in the world for hundreds of years. And if you just go into the United States, for example, the GAAP, or generally accepted accounting principles, really dates back to the 1930s and really started kicking in the 50s, 60s, and 70s. And GAAP accounting has many, it's an 1,100-page document, but the there's two fundamental financial principles that have stood the test of over 100 years. One is that you must count everything that is material. And the second is that you can only count things that are material once, not 0 times and not 2 times. And the state of carbon accounting today, or carbon counting, already violates those two fundamental principles. Forgetting things like accrual, conservatism, consistency, and cost accounting, which are also parts of GAAP. So we don't really have GAAP accounting in carbon accounting yet. We have just carbon counting. Ultimately, when the world is rapidly moving from carbon counting to carbon accounting, thanks to companies like Novata and thanks to industry working groups. But ultimately, what you're going to have is you're going to have a carbon ledger where you have assets and liabilities, where you have a balance sheet and you have things that come in and things that go out. For example, if you buy carbon removal, that's an asset. It has to go on your balance sheet. If you have a big emissions factor or a big emissions activity, that's a liability. And ultimately, you are trading off these assets and liabilities in a carbon ledger. The other thing that's sort of interesting in a very macro sense about the world is that the world's carbon ledger doesn't add up. If you think of, I know I'm sorry with the Excel analogies, but if you think of just a big Excel spreadsheet where all of the countries in the world, so the 198 signatories of the Paris Agreement, those are all the columns. So you have a column for every country in the world. Those countries all report their emissions at a country level. And then you have companies as all the rows. So a company like Microsoft is a multinational company that has materiality of emissions in many of those countries. That doesn't add up today. So there are a lot of global carbon accounting initiatives really trying to get that ledger to foot, which requires just lots and lots of small tweaks and changes in methodology and changes in reporting standards. And, it's just, but we are in the good news is we are in the process as a world and as a country of moving from carbon counting to carbon accounting, where there is actually a ledger. Companies really that are trying to get started really shouldn't worry about that macro construct. And the most important thing is to just get started with their own journey and let these standards things evolve. But I think it's probably going to be another 5 years. They're evolving rapidly. It's probably going to be another 5 years till we can really say, okay, we have really tight carbon accounting in the world. But the good news is it's happening and it's happening quickly.
Thanks. I do. I hear what you're saying about just getting started, be on your own journey, run your own race. But I also think putting all of this in the context of something that is quite familiar, like accounting, is a very helpful way to think about how to conduct this long term and how it really fits into an overall strategy of financial, non-financial, whatever you're trying to collect, as it is to manage your business and understand performance. So I think that I'm glad to hear that you feel optimistic that we're moving forward with that standardization. We talked about teams, building teams, getting buy-in, how to get started with carbon accounting, some of the challenges, and where we are as an industry. There are a lot of tools and resources available to help investors and companies with this journey, Novata included. So what should firms be looking for when it comes to evaluating a technology tool to help with carbon accounting? And Mark, maybe talk about some of the investments that we're making to help our clients.
Yeah, thank you, Meredith. This is actually a nice segue from what Mark was talking about just now, which is that I feel we've been going on a technology journey in the carbon accounting world that is similar to what was seen in the financial accounting world. Back probably in the 50 to 100 years, maybe accountants were there with a book, literally doing their double entry bookkeeping in a journal, and then over time they went into whatever tool they were using, and then now these financial accounting software tools are ubiquitous, right? Every single accountant will be using a SaaS tool to help with their accounting, and that technology has just become more and more mature and more advanced. And in the carbon accounting world, having experienced this firsthand over the last 5 years, it has matured rapidly. And we've building this on the ground. We've seen that the vertical stack of tools available has really come on leaps and bounds. For example, we can now, as mentioned, we have a tool called the Novata Carbon Navigator. We can now integrate directly via API with all your financial data. So whether you're using a Microsoft Dynamics or a NetSuite or a Xero, we can programmatically pull that data in at the click of a button in a fully automated way. Similarly, we're also interfacing out to other systems like companies like Climatic and Bend, based in different parts of the world, doing different things, to complete the other part of the puzzle. So the data's come in. Well, how do we convert that into carbon emissions? Well, we can bring in data from other third-party sources, again, immediately at the click of a button. And so what you can bring together is a tool that can really give the person and the team leading this carbon accounting effort, really give them superpowers to a certain extent, where no longer is this an annual, multi-month, really laborious process that involves huge numbers of different departments. Instead, you can get the technology set up once, and then when it comes, then you actually have more of a live view and a more kind of dynamic, real-time view on your carbon emissions that can be used to drive action, business intelligence, business value, and move this less from a cost center and a compliance exercise to something that can be really powerful. And so to answer your question directly, Meredith, I think when selecting a vendor to help with carbon emissions calculations, you should be looking for some of those really advanced technological developments in the space and the ecosystem as a whole. Things like integrations, things like automating different parts of the puzzle, calculating emissions in a dynamic way, and so on. And that's really what we endeavor to build with the Novata Carbon Navigator.
Thanks. I think building on what you said, maybe everyone should just say, will this tool give me superpowers? I love that you distilled it down like that. Mark, are you seeing anything beyond what Mark Fischel described as helpful to the companies that you're working with?
Yeah, I think he really nailed it when he talked about this idea of integration. The most important thing to think about when you have a tool like Carbon Navigator is that it is a new system of record. It is your company's environmental sustainability system of record, but it does not work in isolation. It is a system of record that is pulling data from all these other systems of record that you have in your company already. So you may have an ERP system. It has to connect with that. You might have Bamboo HR or another SaaS product that has employee data in it. It has to connect with that, and employee commuting data. And so there are all these systems of record that a company already has. Those are still valid. They're as important as ever. And the most important thing with something like Carbon Navigator is that it has APIs and simple connectivity to the data that exists in all these other places in the company. So there's a subset of all your company data that has to do with environmental sustainability, and a tool like Carbon Navigator connects to all those systems and pulls it into one centralized place to create a new system of record that builds on all the other systems of record in the company. And so it's not a thing that works in isolation, and that connectivity is the most fundamental thing. And a good tool will make that simple. So you're not having to hire complicated IT people to, cleanse all this data, but it just comes in and the Novata system does the work for you.
Thank you. I've just started to look at some of the questions in the chat. If you have a question and you haven't entered one yet, please use the Q&A widget at the bottom of your screen. But we have covered a lot of ground. Let me start with this first question. It's going back to a point of clarification, I think, on CSRD, Mark Cruz. How do regulations affect US asset managers? And if they have more than 20 million AUM from European investors, they do have to report. I think that is the number you gave, 20 million.
That is correct. I'm not exactly sure if AUM is considered uh, against the revenue threshold. So that is something that will need. There's two caveats to that question. One is I'm not sure AUM, assets under management, right, is considered revenue, but it probably is. And the second is that CSRD does roll out in phases. So those 50,000 or so companies that are affected kick in various phases in 2025, H1, H2, into 2026. So that is something that you might ask ChatGPT to check the 200 and something page CSRD regulation. But I think that is correct, but I can't say with absolute certainty.
Thank you. And diving a little deeper into the regulations for US asset managers, I know you mentioned the SEC. We also have regulation coming out in California that will affect US asset managers, correct?
That is correct. California is, again, I think if you want to look at what's coming in the world of sustainability, first look to Europe and the European Union and the European Commission and what's happening in Brussels. Second, look to California. I mean, California has its own California, has a thing called CARB, this own resource board. It has its own carbon market. It has the most stringent automobile regulations. It has the most aggressive transition to EVs. California is just a very progressive and obviously large state, and I think the ninth largest economy in the world. So if it's happening in California, it will likely just become the standard in the United States a few years later.
Thank you. And sticking with you, you mentioned supplier code of conduct earlier in the conversation. The question is, why did you mention it? Why is it important? What should we be thinking about?
Yeah, and it's really most important for large influential companies. If you think about a company like Procter and Gamble or Walmart, they have thousands and thousands of suppliers. And in my role at Microsoft, I went and did executive briefings with the C-suite of those companies, and they are really using their power and their influence over supply chain for global good. So, for example, years ago, Walmart said, we will not sell any electronics with a certain type of solder that had real bad negative environmental effects. So we are putting our entire supply chain on notice that 2 years from now, if your product has this kind of solder, we will not sell it. Walmart is 8% of the US GDP. I mean, that is a massive amount of influence. So big companies take a leading role to do their job and basically set standards, just like Whole Foods basically, not environment, said we're not going to sell products with trans fat or anything like that kind of thing. So it's important for big companies to flex. Some would call that draconian. I think it's being responsible. Downstream, but every company, no matter, has some sort of supply chain. So, for example, Microsoft put a bunch of reporting requirements in its supplier code of conduct that says if you're going to do business with Microsoft, you will report your emissions and your sustainability metrics to us annually. And that is a very effective thing to do. So whether you're at the giving or the receiving end of that dynamic, this idea of a supplier code of conduct that influences how this entire supply chain of people work together is very important.
Yeah, I think just to build on that, we've spoken about a few different reasons for how you could build the why for everyone to get behind it, whether that's regulations, maybe like saving money because you identify areas for cost savings. But the single most compelling board level rationale is like, we can make more revenue. And we were speaking to a company literally last week, and we're like, well, what is the motivation for you to measure your carbon emissions? It's like what AstraZeneca is asking us to, and they're like our number one customer. And so I think you can, the business value case is at its sharpest edge when thinking about how can I continue selling to my biggest customers that are asking me to do this. And so, that's just building on what Mark's saying. Like, I think that's the most compelling reason bar none for companies to get on with this.
Yeah, and just to build on that, it costs a company the same to be a leader or a laggard. If you're going to have to do this reporting and you're going to have to set up all these systems in it to enable to do the reporting, if you do it now and you're progressive about it and you lean into it, you get a very good ESG score and the way your business is rating, all of these things, then you're a leader, and there's no difference in cost in being a laggard. So why not get started and be a leader?
Thank you. I think you both just touched on what I wanted to ask you as my last question, but I'm going to do it anyway. We talk a lot about challenges. That was even the name of this webinar. But I'd love to hear where you're seeing some bright spots with investors and companies thinking about or already managing emissions in a way that is really material to their business strategy. So, real quick, Mark Cruz, why don't you start? What's a great example, a bright spot?
Uh, I think one of the bright spots I'm seeing is the sophistication in methodologies that is occurring. And broadly, what most companies will use is what's called a spend-based methodology. So if you buy a bunch of AC or electricity, you have a bill, and then that invoice is estimated to be a certain amount of emissions based on the spending, which are based on industry averages. A more accurate method is what's called an activity-based methodology. So in a building, if you have an HVAC unit and it's pumping electricity, instead of waiting for the invoice to come and go full round trip and estimate it based on the invoice, you can actually connect that device to a cloud like Novata or some of these leading systems. And whenever that HVAC unit is spinning, it's recording the data in real time, and you're bypassing this whole wait for the invoice and estimate it based on spending. So to summarize, the transition from spend-based to activity-based methodologies is a really exciting thing that will get that carbon ledger in the world to be more accurate.
Cool. Mark Fischel?
Yeah, so I think I can only echo what Mark just said, and I think we've spoken about the technology improvements, which I think is a real bright spot. I think the other part that I wanted to touch on as well is scope 3 is challenging, but it's also a huge opportunity. Like, part of the challenges that come from scope 3 is that it's indirect to an organization. So it's suppliers, it's customers, it's portfolio companies. That's part of the challenge. It's outside your four walls. But also, it's kind of the opportunity as well, because you both participants have a shared ownership of those emissions, and therefore both have a shared benefit if those emissions are eliminated. So that kind of shared responsibility problem is a problem in one sense, but is also an opportunity, because it means you're both bought in to, you both get to claim the benefits if you make positive improvements to decarbonize. So I think that's the kind of curse, but also the blessing of the way scope 3 is set up.
Great. Well, thank you both for participating in this conversation today. That was a great discussion with a lot of actionable takeaways. What I heard was that you have to know your why, bring your organization along. This is a team sport. Be a row in a world of columns. Don't get overwhelmed. Start with S1, S2, and then think about what's really material to your business and start to learn more about scope 3 and make decisions around that. And then find a tool that gives you superpowers. And that's really what will make the difference between being a leader or a laggard, both of which cost the same. So why not be a leader? Thank you to everyone who joined us today, and to PE Wire for hosting us. Thank you, Mark and Mark. PE Wire will follow up with the webinar recording, and Novata will be providing a complimentary carbon playbook, all the reading that you need for a fabulous summer of carbon. This is our interactive guide with links to tons of resources for carbon accounting, no matter where you are in your journey. And for those of you who want a little deeper dive on CSRD, we also have a guide on that on our website, novata.com. If you have any questions, email events@novata.com or reach out on our website. And thank you very much for joining us today.